Hi, Alejandra. Um, let me wait a couple of minutes for other guys, maybe just 2 or 3 minutes. I will start in 2 minutes.
Okay, sounds good.
Okay. Okay, let me share my screen. Yeah, share my screen. Yes, I think you can see my screen right now. Okay. Can you hear me right now?
Yes, I can hear you.
Okay. I just okay. Okay. I'm just looking at the people. Yeah, the participants. Yes. Okay. I think you're the only one now attending this session. Okay. Um, I think we should start because this is the time is 11:03, and we need to cover 3 chapters. Let's get started, and we will see. The other guys may join the meeting. Okay. I just want to um, ask actually before beginning. Do you want me to cover all the chapters, including the definitions, explanations, or should we go only the questions? Maybe I just talk very quickly the concept and the content of the each chapter, and then I quickly go to the questions and solve the questions. I don't know which one.
I think I prefer just going over main points and then looking at the example question.
Okay, perfect. Okay, let's get started. As you know, we have quiz today at 2 p.m. after 2 p.m. and we have exam on Monday. So all the exam questions, the exam first exam includes from chapter 1, 2, 3, yeah, 1, 2, 3, and chapter 4, 5, and 7. And today's quiz 2 only includes chapter 4, 5, and 7. So I'm just to this section I will be concentrating on chapter 4, 5, and 7, and you can find all the materials for the other chapters, chapter 1 and 2 and 3, um, in the on the blackboard. Okay, let me start. Chapter 4 is the securities markets, and as usual, I show the chart, the savers, borrowers, financial institutions, financial markets, indirect transfer, direct transfer, and let me explain market makers and brokers. In the market, in the securities market, we have organized exchange and organized markets and decentralized markets. Organized markets, when I say organized markets, just think about the exchange, for example, New York Stock Exchange or American Exchange. And decentralized markets are the over-the-counter markets, example OTCQX. And the NASDAQ is the National Association of Securities Dealers Automated Quotations. It is the centralized market, organized market, even though there could be some confusion whether NASDAQ is decentralized or centralized. This is centralized market, organized market. And yeah, so on the over-the-counter markets is, we can say they define that these markets are decentralized markets in which market participants trade stocks, commodities, currencies, or other instruments directly between two parties. Maybe I can explain when you in this way. Maybe when you want to trade stocks, you go stock exchange and you can buy Apple stock or Netflix stock through New York Stock Exchange, but also you can trade or you can buy stocks through OTC market. In OTC market, there's no stock exchange. You can just go to the investment bank account, and investment banks such as JP Morgan can find the buyer and the seller in their house. So just quickly simplify the concept. Organized exchange. When I say organized exchange, this is New York Stock Exchange or American Exchange. When we talk about over the counter, we're saying there's no exchange. Parties can buy and sell stocks to their brokerage house. And market makers, market makers is the entity, the investment brokers. They can buy and sell stocks for their own account in order to enable the liquidity to the market. Brokerage firms, this is the agent that buys and sells stocks from a security dealer in your name. So you need to have brokerage house to buy or sell stocks in the stock exchange. And market makers, as I said before, they are the guys who enable the liquidity to the market, and they buy and sell stocks for their own account. And because we need the market makers, because if no one sells at the time that you want to buy stock in the markets, in the stock exchange, they enable, they sell the stock, and and vice versa. So we call them designated market makers. So every stock has at least one DMM, designated market maker. So how they make money for the spreads, ask and bid spreads. The difference between the bid and ask price is the cost to the investors, and this is the cost for the investor, but the designated money makers make money from this spread. So we have round lots, which is 100 stocks, and odd lots, which is different than 100 stock. So yeah, money makers facilitate securities transactions, do not set the level of prices. Prices determined by supply and demand. These guys just give you liquidity to the market, and they're selling stocks if the investors want to buy stocks, and vice versa. And what is the types of orders? Market orders, limit orders, and day orders, good till canceled orders. Market orders executed at the current bid and ask price. Limit orders, specified price. You just want to buy at some level of price, and these orders can we divide these orders in day order or good day order or a good till canceled. You can give the order like daily. You can say, okay, Apple now traded at $373 per stock, and you want to buy that stock at the level of 320, not the 327, you're saying, okay, I can buy that stock at the level of 320. So this is limit order. It's just day order, and it will cancel out at the end of the day. And we have also market order. You just give the order right now, and if it's executed, it's done. If not executed, it's just canceled out. And in the, I don't know whether you are trading stocks, but if you want to buy stocks, you're paying commissions to the brokerage houses, and we have a settlement date. And what is settlement date? Settlement date, you register the brokerage house. You want to buy a stock, let's say Apple stock, and you give the order, and yeah, you just your order is executed. You're done, and the brokerage house let you know, okay, your order is executed, but the settlement date is T plus 3, meaning that T is the executed date, plus 3 is the settlement date. You will own the stock at 3 days later, later the execution date. Even the execution date is today, you will own that stock at T plus 3. I think it's clear. And this is the confirmation statement of the executive purchase. Once you go to, once you decided to buy a stock, you know, and you're using Fidelity, TD Ameritrade, or Charles Schwab, or maybe Robinhood. And once you buy the stock or sell the stock, they will let you know, okay, you bought the stock or we sold the stock, and this is the confirmation statement. You will see the how many stocks you bought, the number, the price level, the name of the company, and the gross amount, commission, as you see, that amount, the symbol, and settlement date. Okay, and we have another term, margin call. And margin account is the buying stocks with a combination of your cash and the credit supplied by the broker. And margin is defined as equity over total value of the portfolio, meaning that you have $8,000 in your account, but you want to buy the value of portfolio at $10,000. So the margin is 8,000. The calculation is simple. It's in the numerator you have equity, and the denominator we have total value of the portfolio. So but the brokerage house, let's say Charles Schwab, says that, okay, we are serving you in the circumstances. You need to have at least 60% margin, meaning that at least this ratio should at least 60%. So when you have lower than 60%, they just they call you and saying that, hey, you just you have a margin call. You need to add some more cash in your account. So the margin requirement simply says that the minimum percentage you must pay in cash in your you must have in your account. So you can borrow the rest from the broker and pay interest, but this is the minimum cash you need to deposit in the brokerage house. So this is the market requirement. So financial leverage is the use of borrowed funds to magnify the percentage return on the investment. So the concept is simple. You have cash and you can take loan, and the taking loan simply identifies the financial leverage. As I said before, the margin call is the request of additional funds. When we solve the question, a problem, you will see what I mean. Let's solve a quick question. So you buy 50 shares at the $20 each, and the margin is 60%. What was the margin? The margin is equity divided by total value of the portfolio. Okay, so the margin is 60%. Let's say in that scenario, the shares up to the $30. So you bought $20, but the shares goes to $30. You're in lucky day. And what is the return with no financial leverage? You're not using any loan from brokerage house. So return investment is the profit divided by initial investment. You deposit $1,000 cash in brokerage house, and we need to calculate the profit. What is the profit? You multiply $50 by $30, 50 shares by $30, which is 1,500, minus what is the cost? $20 per stock, multiplied by 50. Your cost is 1,000. The profit is the difference between 1,500 and 1,000, divided by initial investment, which is 1,000. So your return investment is 50%. What if you use a loan from brokerage house? So let's calculate the return on investment. So you have $1,000, and you can use only 600,000, and you can loan 400,000 from brokerage house. So you're investing only 600 here. In that scenario, excuse me, you don't loan anything. You just you need to only deposit 600, and you're investing the stock. And in that scenario, your initial investment is only 600, because the margin 60%, and the profit is same. In that scenario, you have 63%, 83% return investment. Okay. So what is long position and short position? It's easy. Long meaning bullish position, meaning that you're anticipating the prices will increase, and you purchase in anticipation of price increase. The short position meaning you're selling because you anticipate that the prices will decrease. We're selling the bearish position or the bearish market. After the coronavirus, we have bearish market, and the stock prices fell down. So what are the indices? By the way, you can ask a question anytime you want to ask. And indices, we have Dow Jones, S&P 500, New York Stock Exchange. We have plenty of index indices in the market, like S&P 500 index, meaning this is the 500. It includes 500 stocks, the largest stocks in the market, in the sense that the market capitalization, they only includes 500 stocks in this index. And Russell 1000, they have 1000. Wilshire 5000, they include 5000, and so on and so forth. And foreign securities, foreign stocks traded in American markets, like companies in European countries like Germany or London or England, they can trade their stocks in New York Stock Exchange. So what they need to have American deposit receipts. These ADRs avoids the problem of language, expresses in dollars and not the local currency, registered with the SEC. Also, bonds sold in foreign countries, bonds issued by the foreign firms, bonds issued by foreign governments, bonds issued in foreign countries by American firm. Eurobonds, bonds sold in foreign country but denominated in the currency of the issuing firm. So let's say U.S. company want to sell it. One U.S. company want to sell its bonds in European countries, let's say in Germany. They call it Eurobonds. Okay. And competition, meaning easy entry and exit, sufficient liquidity, and information disseminates rapidly if competition is high. Price changes occur quickly if competition is high. And let me introduce a new concept, which is efficient market hypothesis. It is introduced in 1970 from Eugene Fama, Chicago Business School. And basically it says stock prices adjust quickly to new information. Stock prices should reflect all available information. Investors cannot expect to consistently outperform the market because stock market is very efficient, and once a new information is occurred, the stock prices reflect all the available information regarding that stock. So also empirical results supports the efficient market hypothesis, and there are some exceptions, anomalies to efficient market hypothesis. There's another school of thought contradicts this efficient market hypothesis, which is which is Robert Shiller from Yale University. Also, maybe you heard about the behavioral finance. They simply say that investors have some behavioral biases, familiarity biases, home biases, etc. And the investors are not rational as efficient market hypothesis assumes. So just a quick note. Okay, let's look at the chart. As you see, this is the price, the daily price of the FCA stock prior and after the announcement of being acquired of Mars. So Mars company in 2017 acquired VCA company as a acquisition in January 9th. So if the market is extremely efficient, what do we expect? Once the news disseminated, the stock price reflect immediately. Before the event, the stock price is 70.77. Once the new event is just disseminated in the market, it's quickly reflect in the stock price, and stock price just instantly jump from 70 to 90. And this dashed line shows the price adjust in an inefficient market. Maybe you can just draw this line this way or this way. It takes very long time to adjust market. It says the market is not efficient because it reflects very slowly, right? Let's solve another problem. You purchase 100 shares of the Apple for 100 per share. After the year, the share price rise 120. What is the return on investment if you do not borrow funds? In the second scenario, what is the return of the margin requirement is 60% and you borrow the rest. Okay. It's similar question that we solved before. So in the second problem, the stock price went down 80. In the first problem for A, the stock price rise from 100 to 120. Let's solve for the first one. Okay, we buy 100 shares at $100 per share. What is our cost? Just multiplication 100 shares, and the price of share is $10,000. This is your cost. What is the margin? 60%. So you need at least $60,000 to purchase the $1,000 cost of stock. So it just says that 60% margin, you need at least 60,000, and you will get loan from brokerage house 40,000. In total, we have 10,000, right? After 1 year, your investment, you're very lucky, or you're very right, you're a wise investment, and you know the Apple stock has a value and increase has the potential to rate potential of their value, and the stock price goes from 100 to 120. So the new value of 100 stock is 12,000. What's your profit? Easy. You invest 10,000. Now the stock value is 12,000. This is your profit. What is your initial investment? 10,000. This is without margin, because in this scenario you don't borrow money. You just use your cash. What is your margin? What is your return on investment? Profit is 2,000. Your investment is 10,000. 2,000 over 10,000 is 20%, your return investment. But if you use margin, you use a loan, you borrow loan. In that case, you only invest 6,000 in cash. Your return is 33.33%. This is important. You probably see this. Yeah, this is an important problem. Anyway, for the second scenario, as you may remember, let's go the second option. In that case, we buy $100 per share, but the stock just went down 80. In that scenario, we don't have profit. We have loss, right? Loss is 2,000 minus 2,000. Investment same. Initial investment is 10,000. What is our return investment? Minus 20%. What if we borrow some loan according to margin, which is the 60%? So in that case, our return with margin is at minus 33.30%. Is it clear? I guess. I think it's clear, right? So okay, this is the chapter 4. Let's move on chapter 5. Let's find chapter 5. Okay, let's find chapter 5. Slides, chapter 5. Okay. Okay, we have chapter 5 is for federal. It's a quick chapter. Let's cover very quickly. So talk about this place in diamond. You already know this. So the role of Federal Reserve, it's the U.S. Central Bank, and the Federal Reserve Bank regulates, manages the supply of money and credit in the economy to achieve. So they have some targets, which are the stabilize the prices. Target inflation rate is 2%, and they target the full employment and economic growth. What is the structure of the Fed? We have board of governors, 7 people, and chairman. Now the chairman is Jerome Powell, and we have 12 districts and 9 directors. We have member banks, and in that the structure of the Fed, we have Federal Open Market Committee, which establishes and executes monetary policy. Let's look at this graph, this figure. We have 12 district Fed banks, and maybe you heard about each of them. Like the most famous one is the Fed New York. So we have 12 district banks. Let's look at the structure of the Fed. So in this chart, you see the structure of Fed, and the President of the United States appoints the Board of Governors, and Board of Governors appoints 3 directors of each district bank, Fed district. Like, let's talk about only one district, Fed New York. And Board of Governors appoints 3 directors for the Fed New York, and member banks of the Fed New York, they select or elect 6 directors. And so we have 12 district banks from for 12 district banks, they elect 4 representatives for the Federal Open Market Committee, and so 7 members of the 7 members comes from the Board of Governors, 1 member from New York District Bank, and 4 other comes from the president of the 4 other district banks comes from the other district banks. So as you see, the Board of Governors is the main body, is the most powerful body that appoints everywhere, 12 district banks and all the Federal Open Market Committee. What is the responsibility of the Federal Open Market Committee? Let's talk about that. So open market, they are responsible for the open market operations, which refers to a central bank can buy or sell short-term treasuries in the open market in order to influence the money supply, thus influencing short-term interest rates. So when Federal Open Market Committee buying securities, meaning that it adds money to the system, making loans easier to obtain and interest rates decline. When Federal Open Market Committee decides to sell the securities like treasury bonds, they are selling the securities and from the central bank balance sheet, removes money from the system and making loans more expensive and increase rates. So these open market operations are the method the Fed uses to manipulate interest rates. So it's very useful method that they can increase or decrease the money in the system. Quickly, they can just sell the treasury bonds or buy the treasury bonds. They can supply money or contract a money supply in the system. So, okay, Fed controls expansion or contraction of the money supply. So we have three important terms, which is reserve requirement. This is the requirement that the Federal Reserve asks the member banks to put some portion of their reserves into the Fed. So as you remember, this shows the importance of excess reserves. What was excess reserves? You may remember I think chapter 3 or 2. Excess reserves is banks have some reserves, like suppliers or savers deposit some money in the bank account, and but the bank needs to deposit some portion of that amount to the Fed. So this is required reserve, and the difference between reserve they have in their bank and the required reserve they need to deposit in the Fed, this difference is excess reserves, right? What is discount rate? Discount rate is the interest rate charged banks for borrowing reserves from the Fed. So Fed charge banks, the member banks, when they borrow money from Fed. What is open market operations? Same, I just explained buying and selling government bonds. This is the most important monetary policy, right? So let's quickly go to next slide. Okay, I explained these terms like reserve requirement, excess reserves. I just skip. Okay, this chart is important. Okay, let's explain the process of loan creation. Okay, first bank, you have $100, and you go a bank like Bank of America and you deposit $100, and the cumulative new credit is 0 for this bank, and the requirement of this bank, the required reserve is $10, because let's say the reserve requirement is 10%, they need to deposit this amount, 10% of the deposit amount to the Fed. So the cumulative required reserve is $10. So this goes to the Fed, and excess reserve, they have 90. So they have excess reserves, 90. They give loan. So Bank of America gives a loan to the other person, let's say person B, and this guy just go other bank, JP Morgan, and they deposit the $90, and cumulative new credit is $90. And what is the reserve requirement for $90? It is 10%. What is the 10% of $90? It's 9. What is the cumulative required reserve is 10 plus 9 is 19. What is the excess reserve is 81, because 90 minus 9 is 81. So it's now again JP Morgan loan this excess reserve to other guy, and other guy goes to third bank, deposited, and cumulative reserve, cumulative new credit is increased 171. Same process. So there's some cumulative new credit. You see, only one guy in the market, in the financial system, deposit $100 in one bank, and in cumulative way, the new credit is generated 900. Interesting, right? So how can we calculate these 900 bucks? There's a quick formula. So change in excess reserve divided by reserve requirements is change in money supply. So the first guy, let's go back. This is the excess reserve, 90. We take this $90 divided by the reserve requirement, and we will find the change in money supply in the financial system. So simple calculation. Okay, let's go the next one. Okay, please remember the federal fund reserves and the discount rates. What was the federal fund rates? It's the interest rate charged between banks on overnight loan of reserves. What is the discount rate? Discount rate is the interest rate Fed charges banks for borrowing reserves. Okay, let's go the next one. So yeah, the Federal Reserve has three primary tools for affecting the reserves of depository institutions. The first one is reserve requirement, discount rate, and open market operations. Okay, let's repeat again. The reserve requirement is the increase of reserve requirement will immediately decrease the bank's capacity to grant loans. Let's say they have 10%, but the Fed decides, no, you need to deposit at least 20% or 30% or 50% to the Fed, so that immediately decrease the bank's capacity to grant loans, right? This is infrequently used and has the announcement effect. Okay. Okay. Am I recording? Okay. Let me check something. I just want to. Yeah. Okay. We are recording, right? Yes. Okay. Perfect. And okay, discount rate is the second tool. This is the change in discount rate is intermittent. This is irregular, infrequent. Instead, target Federal reserves are very common, frequently used by Fed. What is a target Federal fund rate? This Fed established a target rate, and the current Federal fund rate is now 5 basis point, meaning that 0.05%. And what is do you remember the Federal fund rate? Let's go back. Federal fund rate. What is the federal fund rate? Federal fund rate is the interest rate charged between banks on overnight loans of reserves. Okay. So Fed uses open market operations to achieve target rates. They're selling or buying treasury bonds to achieve target rate. This is a quick chart or funny chart. You know, this is Paul Volcker, and the height of the Paul Volcker is higher than the Alan Greenspan, and Alan Greenspan is taller than Bernanke. As you see, the interest rate is going down and down. This is funny, you know, just a quick chart. So it's not, there's no relationship between their heights and interest rates. That's just maybe you can recall the interest rates getting down and down during these years. Now we have Jay Powell. Now interest rates actually lower than the Janet Yellen, right? Yeah. Anyway, so okay, this is just a quick summary of open market operations. Just a quick summary. And what is the open market operation? Central bank purchases and sales of securities in open market as a way to implement monetary policy. What is the monetary policy tool used for? This tool helps the Fed promote stable prices, maximum employment by changing the supply of reserves in the banking system, which influences interest rates and supply of credit. We have two monetary policy. The one is expansionary, the other one is contractionary. What is expansionary monetary policy? The Federal Open Market Committee wants interest rates to decrease, and it enables yeah, it just injects reserves into the banking system, and it puts downward pressure to the federal fund reserve rates and other interest rates, encouraging borrowing. So when the expansion of monetary policy, the interest rates, the borrowing rates getting lower and lower, people incentivized to take loans and spend money. And the contractionary monetary policy is just opposite. They use Federal Open Market Committee once the interest rates increase, and it puts upward pressure on the federal funds rates and other interest rates. When the interest rates getting higher and higher, investors or people in the market, they don't want to borrow money because the interest rate is very high. They also encourage saving money. Okay, quickly. Okay, this is fiscal policy. Fiscal policy is different than Fed policy, and sorry, monetary policy. So fiscal policy is implemented by taxation, spending, government spending, or debt management. As you see, the government spending exceeds revenues in US. They're measuring this deficit by the percentage of the GDP. Now it is 4.7%, which is getting higher and higher. Okay, source of funds to finance the deficit. How can the government finance this deficit? By commercial banks, non-bank, public, or Federal Reserve, or foreign credit markets. They need to finance this deficit. They can borrow money through the international credit market or other resources. Okay. Okay, I will skip this chart. Yes, this is just summary of the what I said before. What happened if borrowing from general public to change of money, case 1, case 2. Just review this chart on your own. Inflation, this is general increase in prices and measured by consumer price index. Now in US, we have in 2019 CPI, this is consumer price index is 2.3%. And high inflation is beneficial to borrowers, bad to creditors. Yeah, and fight inflation by, how can governments fight inflation? Contracting the money supply. If they contract money supply, people, it means it narrows the credit market, and people hardly get loans, and they hardly spend money, and they're raising interest rates, right, and raising taxes. When the government increases taxes, is a fiscal policy that just as another tool for to fight inflation. Okay, inflation is just opposite of inflation, general decline in prices. What is recession? Just know these terms. These are important. You will see these terms in quiz or exams. Recession. Now, what does the recession means? Recession is reduction in nation's level of output. How can we measure the level of output in the economy? GDP, gross domestic product, and also recession means increase in unemployment. Okay, let's wrap up. What is the time? Oh, 45 minutes left. We spent 45 minutes for 2 chapters. Okay, I need to speed up. Okay, this is just a problem. Let's solve this problem. You invest $1,000 in a saving account in the beginning of 2014, and interest rate is 0.5%. How much you have at the end of 2015? Let's solve the first one first. Okay, so this is the money you are investing, $1,000 multiplied by the interest rate, and what is the you invest one in 2000, okay, 2015. Yeah, this is important. Okay, this is important. Why? It says the beginning of 2014 and end of 2015. So how many years we have? at the beginning of 2014, we have 1 year, at the end of 2015, and another year. So in some, we have 2 years, right? We have 2 years uh, in our calculation. So that's why we are putting 2 years. The interest rate is 5%. Is it 5%? No, it's 0.5%. It's 0.5% over 2 because we're investing 2 years. What is the amount we invest? 1,000. So what we get in 2 years, $1,000, 1,000, and the 10.0.3, $1,000 above $1,000. Simple, right? Section B is asking, considering CPI, this is the inflation, consumer price index was 0.8% in 2014 and 0.7% in 2015. How much you should have at the end of 2015 just to keep the purchasing power of your money? Let's look at the answer. So at the end of the 2014, so you have $1,000 in cash, but the inflation rate is 0.8%. So in order to keep your money same, or in order to keep your purchasing power same, you need to adjust this amount by multiplying 1 plus the inflation rate, which is $1,008. $8. Yes, for the for the end of 2015, now we're using not 1,000, we're using 1,008 multiplied by what is the inflation rate for 2015? This is 0.7%. So in order to keep the purchasing power, you need to have 1,015.01. Okay. Is a saving account a good investment? What are the advantages and disadvantages? It depends. Why? Because yes, if you're a risk averse or averse to risk and or may need to amount in the short term, maybe it's good for you. The answer no if you want to invest for a long term and can tolerate some risk. Okay. So what is the advantage? Risk-free up to 250,000 because you are insured by the agency, by one of the agency, if whether the went to bankrupt, your investment up to 250,000 is paid you back. Disadvantage currently it's not even covering your inflation. So when you compare the inflation level, like we have more than 2%, what is the interest rates? It's less than 2%. So even you don't cover the inflation rate, you don't you don't keep your purchasing power by investing in a saving account. Okay. Anyway, we just complete this section, chapter 5. Let's go to chapter 7. Where is chapter 7, part 1? So I divide chapter 7 in 2 parts because it's a very big chapter, and let's quickly cover. I want to solve the questions, not to explain all the details of this chapter because we already spent almost 50 minutes. Okay, so this is very important chapter, the time value of money, part 1. So let's skip this. So in general, a dollar today is worth more than $1 in 1 year. If you have $1 today and you can deposit it in a bank at 10%, let's say, you will have 1.10 at the end of 1 year. So difference in value between money today in the future is the time value of money. So it's extremely important concept in finance. Okay. If you deposit $100 in a saving account that pays 5% per year, how much money will you have at the end of the year? Same, you have 1,000. This is the principal amount that you just deposit, $100. Multiply by 1 plus interest rate, which is 5%. So you will get $105 in 1 year. How much money will you have at the end of the second year? So at the end of the first year, you have this amount, which is 105. So if you invest this amount one more year, you will get 5% interest for the next year. So in total, you have $110.25 in 2 years. If you are standing at the time of today, 100 is called present value or principal. 105 and 110 and 25 are called future values. It's easy, right? If you have any question, just ask me right away and stop me, okay? The total interest rate is 10.25 because you deposit 100 and at the end of the 2 years, you have $10.25 interest, which is composed of $10 interest earned initial amount and 0.25 that occurred during the second year on the $5 interest earned in the first year. Yes, okay. This earning of interest on interest is called compounding. This is compounding. Why? Because you are having interest payment on the interest payment. What I mean by that, you earn $5 interest at the end of first year, and you're investing this $5, right, for the second year. So you have interest payment for the end of first year, $5, and you're investing this 5 interest rate payment for the next year, and now you're getting interest payment on interest payment, and you receive 10.25 in total. And we call it compounding interest. We call it compounding. Okay. Payments are either a single payment, a series of equal payments, a series of unequal payments, and you can calculate this compounding or simple interest payment calculations through Excel or financial calculators. I strongly recommend you learn how to use financial calculators. I don't know whether you already got one, but you definitely need one, and because it will be super easy if you use financial calculator, because it's just built-in functions or built-in yes, let's call it functions in the financial calculator. You only enter the values and you will get the results just instantly. Okay, so let's look at the future value. So the formula is future value is the price now, or the principal amount you're investing times 0 multiplied by interest rate. This n is the number of compounding periods. Please remember this this term. It's super important because this is the number of compounding periods, because the compounding period can be 1, compounding period can be 2, 3, 4. It's different than the number of years. The question can ask you, hey, you are investing 1 year, but the compounding period is 2. So compounding period is 4. Then it says compounding period is 4 for 1 year, n is 4. When the question says ask you the compounding period is 12, or monthly compounding, if you have 1 year period but the compounding is 12 or monthly, you're right, retype or write n is 12. Is it clear? Right? It's clear, right? Okay. And Pn, okay, please give attention here. P0 is the time, 0, Pn is the future value. So P0 is the present value, and Pn is the future value. The future value grows increases in the length of time and the interest rate. So let's look at this chart. So when you invest amount in time 0, and let's compare the future value at time 20 for different interest rates. If you're investing money or deposit your cash 5% interest, you will get that amount of money at the end of 20 years. If you invest your deposit money in 10% interest rate, you'll see you have higher future value. If you invest 15%, you have more than 16,000. Please pay attention. The difference is, or the increase is exponential. This is not linear. The exponential. Why? Because this term is exponentially growing. We have power term here. Okay. Power of compounding. As you see, we have original 1,000 investment. This is interest on 1,000 for 1 year, second year, third year, or fifth year, or 20th year, and for 20 year. So you receive funds or received income from your original amount, also the interest amount. So we have compounding interest, meaning interest on interest. Because at time zero, you have 1,000. At the end of 1 year, you get, let's say, $50 for the 1,000 deposit, but you're investing 50 interest rate again, and you receive interest payment on your principal amount, also your interest amount. So interest on interest is compounding. And future value, let's look at this one. Consider an investment where we can invest $100,000 and prevailing market rate of interest for similar risk projects is 10%. What do we expect to receive in 1 year? Similar, you're investing, what is the initial amount you're investing at time zero? 100,000. We call it outflow. Why? Because this is, you're investing money. This is just the outflow of money from your pocket. So this sign is important. We put negative sign because we are investing time zero, and we will get $110,000 in 1 year. This is inflow of money in your pocket. So we just give the plus sign. This is plus, right? We don't need to write plus, but this is plus sign. How can we calculate it? We have just multiply, very easy formula. We just use $100,000 principal amount at time zero, multiplied by 1 plus interest rate, 10%. So what is 1? What is the 1? The 1 is number of compounding in number of compounding, and which is 1. And we receive the future value. The future value is $110,000. So what if we can invest in the project for 2 years? So you're investing, the principal amount is same, 100,000 multiplied by 1.1, because 1 plus interest rate over power of 2, because the compounding period is 2. Okay, let's move on the next slide. So in the financial calculator, I assume you already got one. So in the financial calculator, you will see some variables like PV, FV, PMT, and I. What does it mean? PV is the present value, FV is the future value, PMT is the payments, annual payments also represent as C in the formula, but you will see PMT in your financial calculator. N is the number of time periods. I is the interest rates per period. So in financial calculators, express the cash inputs PV, which is the present value, FV is the future value, and PMT is the payments as cash inflows and outflows. At least one of the cash variables must be, inflow and outflow. We will see what I mean by here when we solve the problems. Okay, yes. If you have a financial calculator right now, you can try. And when you take the financial calculator and you just go to cash flow, push the cash flow button and you'll just type the cash flows. No, this is not the cash flow, excuse me. This is the present value calculation. So, and the financial calculator, you will see a line which starts N, I over Y, PV, PMT, and PV. So same variables that I mentioned before. So just you're typing N, you just push the N and push 2 and enter, and then I is per year is 10, PV is 100,000, and PMT is 0. So you calculate PV by, and you find 121. Okay. And time of money, yeah. So this is just explaining future value. I already explained it. I already explained this. So let's read this. Consider firm's investment opportunity with a cost of $100,000 today and a benefit of $105,000 at the end of the 1 year. Say interest rate is 10%. So today you're investing 100,000, right? And you will get $105,000 in 1 year. So would you invest in the opportunity or deposit in the savings account? Why? Okay. Oh yeah, so it says saving account interest rate is 10%, but for the investment opportunity, the interest rate is 5%. So interest rate is 5%, the interest rate is 10%. So would you invest opportunity or deposit savings accounts? What do you think? Let's solve this. Oh, definitely. Yeah. So let's solve this. As you see, the interest rate is 5% for the investment opportunity, but the saving account interest rate is 10%. So you definitely go for the saving account because it pays higher interest rate than the investment opportunity. Easy. Okay, problem 1. Your grandpa put $500 in a saving account when you are born. If the annual interest rate is 4%, what is the value of the saving when you're about to go college, like 18 years later? So simple calculation, your grandpa deposit $500 in a saving account. So this is the P0. What is the future value? So we can calculate like $500 multiplied by 1 plus interest rate, which is 4%. What is the N, the number of compounding period? 18. So we simplifying this. So it may be hard to manually calculate the value of this 1 plus 0.04 power of 18. So we will just you can use the financial calculator. Just you will see the line of the when you look at your financial calculator, you will see a third line for the Texas Instrument, which starts N, I over Y, PV, PMT, and PV. You just enter N 18, PV minus 500. It's important because it is outflow. You need to type negative sign and 500, and interest is 4%. Payment, this is 4. You don't type 0.04. You type 4, and the financial calculator understand is 4%, and payment is 0. There's no payment during the 18 years. What is the future value of this calculation? So you will find $10,012.09. Okay, and yeah, I solved this question. And now another question. Consider the reverse of our problem. We have an investment where we receive 110,000 in 1 year, and the prevailing market rate of the interest for similar risk project is 10. How much we will be willing to pay today? If we know the calculation, if we know the formula, this is the formula. Is the formula the present value? Okay, the future value is equal. Future value equals to present value multiplied by 1 plus interest rate power of n. So simple manipulation. What is the present value? Present value is the future value over 1 plus r, the power of n. So we have all the inputs of this calculation. We have have future value, we have interest rate, we have N. So simple calculation, we find 100,000 for the present value. Again, you should use your financial calculator in order to get this calculation. Okay, we spend 65 minutes. Okay, we are very close to finish the first part of this chapter 7. We only have another part. I want to spend maybe 25 minutes at most to finish this session. Okay, another same formula as you see. Pn is the future value. The P0 is the present value. So present value is future value over 1 plus interest rate power of n. N is the number of compounding periods. I is the discount rate in percentage terms. Pn is the future value. P0 is the present value. So we call 1 over 1 plus I power of n is discount factor. And calculated previous problem for 2 years. Same. When you take, I don't know which financial calculator you have, but I have a Texas Instrument, and in Texas Instrument, in the third line, you will see NI, PV, PMT, and FV, future value. So I simply just enter the values, and 2 I is 10, PMT is 0 during 2 years, and future value is the 121,000. So I simply calculate present value as the negative 100,000. Why it's negative? Because future value is inflow. We will get 121 in 2 years. So at time 0, we just spend deposit at $100, which is outflow, should be negative sign. Okay. Another question, suppose you won a prize of Met Competition. The grant offers 2 options. You can either choose to receive 6,000 today or 6,700 in 3 years. Which option would you take if the annual rate is 3%? What is the annual rate? What if the annual rate is 4%? So remember or recall the present value. The present value is equals to future value over 1 plus interest rate power of n. So if the interest rate is 3% and the future value is 6,700, you just divide by 6,700 by over 1 plus 3%. What is n? N is just given, says that 3 years here, as you see, the compound period. So we find P0 is 6,000, above 6,000. What if we have 4%? Same calculation, we only use 4% here, and we find just shy of 6,000. So if the interest rate is 3, you accept the price in 3 years. If the interest rate is 4%, you accept the price now. Okay. Now, wrap up. We learn compounding, discounting, future value calculations, and present value calculations. Let's quickly look at chapter 7, part 2. This is part 2. Okay, I will cover in part 2 in 20 minutes. Okay. I don't want to make it too long. Okay, I skip it. We already know future value calculation, which is value multiplied by 1 plus interest rate. We just manipulate this formula and find present value, and we just put the 1 plus r power of n as a denominator. So future value divided by 1 plus r power of n is the present value, as you see. Simple maths manipulation. So what is perpetuity? It's extremely important. Know this. And this is the stream of cash flows where we receive the same cash flow repeatedly over and over again forever. So let's say you will receive dividends, or you will receive some amount of money, same amount of cash flow forever. How can we calculate the the present value of these cash flows. So we just discount all the cash flows, but we have forever, goes forever. So using the formula for present value, the present value of perpetuity with the payment C, or you can say, okay, can I change it? No. Okay, you can, this is C or PMT, whatever, just the payment for each year, right? And the rate is the interest rate. So notice that all the cash payments are the same cash flows, same amount of cash forever. Also, the first cash flow starts at the time one, okay, end of period one. Okay, how can we find the present value of these cash flows? Simple, you don't need to memorize the formula. I already gave the formula, and you can find the formula on the blackboard. So, okay, the formula is cash flow divided by R, interest rate. So how do we find this formula? We can divide everything by 1 over 1 plus R. So we have present value over 1 plus R equals C. C is the payments, right? The only difference is not that the right-hand side is similar to the original, but the power of R larger by 1 because it starts 2. Now we just subtract the expression from the original. You don't need to understand how can we find the formula. Just know this is the formula, and I just try to make things simplify for you. And when you see the perpetuity, which is same cash flows forever, this is the formula to find the present value. Easy enough. So let's solve a quick problem. You're looking for an income investment, and investment bank offers a perpetuity for the price of $125,000. This security will pay the owner $6,000 every year forever. In other words, it is passed on years after that and continues to pay out forever. Starts 1 year from now. The ad says it pays us back in just 21 years. So 6,000 multiplied by 21 is the total value is 126,000. However, we know about the time of money. If the discount rate is 5%, what would you pay to purchase this perpetuity? Okay, let's calculate the value of this perpetuity. Okay, so the payments is 6,000 forever. What is the interest rate? Interest rate is 5%. Please pay attention. We don't divide cash over 1 plus R. No, we divide cash flow divided by R, interest rate. There's no 1 plus R. This is just R. Okay. So should we purchase this perpetuity? So as we know, what is the present value of perpetuity? $120,000. But the ad asks us, charging us $125,000. So we know the worth of this perpetuity is only 120. So we will take our business to a bank that doesn't try to cheat us out of, so we don't, the ad is, just ask us a higher amount. So we don't accept that. So what if we had the same opportunity, but the first 60,000 payment starts today? So it says you will receive 6,000 today and you will receive 6,000 every year forever. So you only add up $120,000 with 6,000, and in total you get the 126,000, which is greater than 125,000. That means the offer, the ad, the advertisement offer is beneficial for us because it is lower than the present value of the value of the perpetuity. So it's cheaper. Okay. So endowing a perpetuity, you just won a lottery and you want to endow a professorship at your alma mater, and you're willing to donate 4 million of your winnings for the purpose. If the university earns 5% per year in its investment and the professor will be receiving the first payment in 1 year, how much will the endowment pay her each year? So again, the outflow times 0 is 4 million, and just asking what is the payments for each year forever. So same calculation, we have what was the perpetuity formula? As you remember, present value equals the payments over R, but you just simple math manipulation and you can find payments, equal payments for each year by stating this way. How can we get this one? Okay, let's go back. So present value of perpetuity is equals cash payments over R. I just multiply by the present value of the perpetuity, multiply by interest rate, and find the payments for every year. So just multiply by PV and R, multiplication of R and PV equals C. So in this formula, we already have the present value, which is 4 million, and the interest rate, which is 5%. So we're looking for the C, which is the payments per each year. C should be $200. We just applying formula. I mean, if you realize, hey, this is just equal payments forever. This is perpetuity. What is the perpetuity formula? The perpetuity formula is the present value equals C over R. You don't need to memorize. You can find the formula in your selected ratio and definitions chart. You don't even use this formula. You can just use your financial calculator, which I strongly recommend if you face this kind of problems. Okay, perpetuity. Okay, what if we have some growth rate of these payments? So the present value of the perpetuity with a growth rate, and in other words, you have some payments, but the payments are equal, but the rate is growing. The growth rate of the payment. So C is the payments every period, R is the discount rate, and G is the growth rate of the payments. So payments are not equal, they're growing by some amount, like 1%, 2%, you have some interest rate. So we try to find the present value of this perpetuity. Let's look at the question. It's easier to understand when we look at the question. Okay, let's solve this question. Josh wants to invest in perpetuity that will pay 5,000 per year, which is C is 5,000. And if the annual amount paid to a project is increased by 3%, what is the present value of the perpetuity if the discount rate is 7%? Okay, we have discount rate, which is 7%. R value is 7%. So the payment is, the growth rate is 3%. Simple calculation, we just put the 3 here, R minus G. So we divided 5,000 by the difference between 7 and 3, which is 4%. We get 125,000. Okay, so annuity is another term, another concept that we need to know. A stream of cash flows where we receive the same cash flow repeatedly every period for a certain number of periods. In perpetuity, we have forever, but in annuity, we have certain periods. So we try to find the present value of these cash flows and find the sum of this value. So let's say you have a cash flow. Usually this is negative because outflow, and you expect some inflows, which are inflows plus signs, and we try to find what is the present value of these cash flows, like time 1, time 2, and time n. Let's solve this. The problem is doing it individually is tedious, but our perpetuity formula only works when the cash flows continue forever. Yes, you will use perpetuity formula, or I strongly recommend use your financial calculator. Okay, let's see the logic behind this formula. So we have present value, cash payments for, let's say, it looks forever, but it's not forever. Like 3 years or 5 years or 10 years or 20 years or 30 years. It's just definite time. And what is the formula of the end periods with interest rate R? This is cash, this is the payment per each period. This is R. R is the interest rate. This is the formula, and you can apply this formula to find, like, let's say 10-year period for the payment of the individual, for the present value of payments for 10 years. Okay, any of the payments can be beginning or end of period. Ordinary annuity cash flows occur at the end of the period. The payments can be at the end of the period or at the beginning of the periods. It depends. Depends. Okay. Okay, let's solve a question. You expect to receive $100 at the end of the. Please pay attention whether it is at the end of each year or at the beginning of each year. So the question asks us at the end of each year for 3 years, how much is the series of annual payments currently worth if 6% can be earned on investment funds? I have 10 minutes. Okay. How much is this series of annual payments worth if the first payment starts now? Okay. You should learn how to use financial calculator. It's super easy. We know the calculation. This is the calculation, right? You can use this calculation, like C is the payment, R is the interest rate, 1 minus 1 over 1 plus R power of n. Yes, you can find the solution by using this formula, but it's easier to use financial calculator because you see we already have a payment function. So you just type payment 100, interest rate 6%, number of periods 3, future value is 0. So what is the present value? You just calculate the present value negative 267.3. And how much this is, okay, the question asks us, you expect to receive $100 at the end of each year for 3 years. How much is this series of annual payment currently worth if 6% can be earned on the investments? And how much is the series of annual payments worth if the first payment starts now? So we find present value. So for now, you get the second one, how much is the series of annual payment worth if the first payment starts now, not the end of the year? So if starts now, meaning that you need to find 1 year interest rate, because think about that. Think about in this way. The interest payment starts at the beginning of the period. So you will receive at the end of the period in 1 year. So you will receive a 1 year interest payment, and interest payment is 6%. You simply calculate the 1 year interest rate, compounding interest rate. Yeah. Okay. NAD. Let's see. Let's look at this chart. Higher interest rate results in lower present values. Longer time period decreases the present value. It's just a formula, and the present value of NAD 4%. If remember the formula, we have present value, cash payments over the 1 plus R power of n. If the annual rate is 4%, 8%. If we have lower interest rate, meaning that the present value is higher. If we have higher interest rate, we have lower present value. Just the formula. And the period also matters. If you have longer time periods, we have longer time periods decreases the present value. Okay. Okay. We have many questions. I can solve some of them because some questions are repetitive. You know, same. Let's solve the first question, problem 4, and let's see how many questions can we solve during the in 5 minutes. Okay. So the question asks, what is the present value of the ordinary annuity of 1,000 for 20 years if the rate of interest is 6%? So simple calculation. We have this formula: present value, payments over R, 1 minus 1 over 1 plus R power of n. Again, you should use financial calculator and just type number of period and interest rate is 6. This is not percent. don't type 0.06. No, just type 6 and payment 1,000 per year. We don't have future value. We just question we are asked to present value, and we simplify negative 11,000, and for present payment of 11 around 11,000, the individual will annually receive 1,000 for the next 20 years. So you deposit 11,469.92 cents, and you will get $1,000 per year for 20 years if the interest rate is 6%. Okay. Okay, let's see problem. Another problem, car payments, you borrow $20,000 to buy a car. If the annual interest rate is 4% and the term of the loan is 10 years, what is the annual payment required to retire the loan? Same logic, same calculation. We have the period, which is and the interest rate is 4%. What is the present value? Think about that in this way. You borrow $20,000, and now in time zero, you have inflow, which is plus sign. So you get the money, the flow of the money is plus sign because you receive this money in your pocket right now, time zero, and this is present value. And simply future value is zero, and the question just asks, what is the payments per year for 10 years? Okay, you need to pay. You will find negative $2,465 per year in the condition on 10 years loan and 4% interest rate. Okay, so future value of annuity, first calculate the future. Yeah, this is important, and so future value of annuity is the first calculate present value of annuity, then calculate future value, or use directly to final formula of future value of annuity. So simply, you will see some questions asking us the future value of the present value calculation. Let's see the question. Okay. So Ellen is 25 years old, okay? And she has decided it is time to plan seriously for her retirement. At the end of each year until she's 65, she will save 10,000 in a retirement account, okay? If the account earns 10% per year, how much will Ellen have saved at age of 65? Yes. How can we find this? How can we find this one? So we just apply the formula, and the future value is 1.6 million at age of 65. Or we can use a financial calculator and just type 30 years, interest rate is 10, and present value is 0, and payment is, because she's saving money per year, which is $10,000, payments with negative signs, saving money and put the money in the account or deposit in her saving account. So future value of this money for the 30 years is over $1,600,000, right? Okay. Similar question, mortgage payments. I just skip because just same logic, and yes, let's skip this question. So valuing uneven cash flows, whether we have not the equal but the uneven cash flow payments, how can we solve this problem? So suppose you are investing in an early stage firm and the project cash flows in 4 years are stated as follows. So you'll receive 5,000 in first year, 6,000 in second year, 3,000 7th year, 7,000 in third year, and 8,000 in fourth year. How can we calculate the present value of these cash flows? on the condition of 10% interest rate. Okay. It's easy because we know the cash payments, cash flows time 0, time 1, time 3, time 4, and interest rate is stable. And what is the n is 1, 2, and 3, and 4. How can we use the financial calculator? I again strongly recommend use the financial calculator. Don't try to calculate this computation. Just go cash flow button on a financial calculator, and you will see the CF button, and you will just type on cash flow time time 1, cash flow time 0 is 0, cash flow of time, this is 0, cash flow 0, cash flow 1, cash flow 2, cash flow 3, cash flow 4, and just compute the NPV. And when you if you familiar with the financial calculator, you're using a CF button and just enter the cash flows for 4 years, and then you will enter the interest rate, and you compute the NPV, which is $20,227, the present value of these cash flows for 4 years at 10% interest rate. Again, same calculation, same logic, and exactly same procedure. So this is another important topic. Let me briefly explain. I know I exceed 2 minutes. Let me explain in 2 minutes what if we have non-annual compounding, because it's important. Converting annual compounding to other time periods necessitates adjusting the number of the time periods and adjusting the interest rate to find the rate per time period. This is done by dividing this stated interest rate by the number of the time periods per year. So this is the formula, but let me first explain it. This is future value, this is present value. As you remember, we have interest rate and number of compounding. What if the question asks us, okay, the annual interest rate is 10%, but compounding is quarterly. So you need to adjust the interest rate for compounding, like it's quarterly, because quarterly means that C is 4. We have 4 quarters in a year, and you need to find the number of compounding, which is N is 1, C is 4, this is 4. For the quarterly compounding. Let's see the question. Okay, so you invest $100 in an asset that pays 8% compounded quarterly, meaning that we have 4 quarters in a year. So what will the future value of this asset be after 5 years? In other words, $100 will grow to what amount after 5 years if it is compounded quarterly at 8%? Let's see. So future value of at time t is P5, is P0 is the time 0, and we have 1 plus interest rate divided by 4. Why 4? Because we have 4 quarter in a year, and this is yearly annual interest rate. And what is the compounding number of compounding periods? We have 5 years and 4 quarters. So in 5 years, how many quarters we have? We have 20 quarters. So we find the future value as 148. Okay. Similar calculations, same logic, and okay, this is. Let me look at the. Yeah, same calculations. Yeah. Okay, let me 1 minute solve this last question. Okay, it may be important for you. So a company has 2 investment possibilities with the following cash flows. Let's say we have investment A, investment B. Investment A, we have cash flow at year 1, 1,400, 1,700, and 1,800. For investment B, we have cash flows at time 1, 1,500, year one, year two, 1500, and year two, 1500. Which option or which project you will choose if we have 7% earnings for each project. So let's calculate what is the present value of the investments for investment A and B. So similar calculation, you need to calculate present value of investment A by using your cash flow function, financial calculator. You just type in cash flow 0 is 0, cash flow 1 is 1400, and accordingly similar for the investment B, and you will find present value of investment A is 4,000, above 4,000, and present value for investment B is just shy of 4,000. So which one is greater? Investment A. So you will choose investment A. It's very easy. Okay. And last question. You are 25 years old and inherit 65,000 from your grandmother. If you wish to purchase 100,000 bought to celebrate your 30th birthday, what compound annual rate of return must you earn? Present value is 65,000. Future value is negative 100,000 because this is outflow. You will buy bought. And what is the time? 5 years, because now you're 25 and you want to buy a boat in your 13th birthday. So you have 5 years. What is the payments? You don't have the payments during the 5 year. The question asks the interest rate. Okay, so the sign of the cash flow is very important here. How can we calculate this? Just third row of your financial calculator. You type N5, enter N5. Future value is negative 100,000. The present value is 65. Payments during the 5 year, you don't pay anything. You just try to find the interest rate. So you will find 9%. Wrap up. We learned compounding, discounting, future value, present value calculations. They are extremely important. You will definitely see the problems in your quiz and exam 1. I think this session helpful for you for the preparation of the quiz 2 and the exam 1. Please let me know if you have any question regarding these issues, the problems. Just email me. I try to email you with the solution. But bear in mind, if you email me within 20 hours before the exam, it will be hard for me to reply all of you, and just give some time to ask questions. Okay, this is the end of the session. I will see you next time. Thank you for your attention. I just close the session if you don't have any question. Okay, thank you so much.
Hi, Sam. Sorry. Late. Bye. Goodbye. I was teaching. Was teaching a session. Was live. Was live. Hi, Sam. Sorry for the delay. I was teaching a session. I'm getting the job market reading the down economy, a panel of the company online. Oh, what the fuck? Take this Christian here. It 第一次不是这么改的吗？OK。